Good morning, everyone. I am Sonal Minhas, and I'm joined by my partner, Anubhav Mukherjee, and my team from Prescient Capital. We really thank you for joining us on a weekend and finding time for this presentation. Uh, the presentation is titled Why We Think It Is a Good Time to Invest in Indian Markets in general and with Prescient Capital in particular. Some of you who've been our clients over the last 3, 4, 5 years, you would have seen through our memos and our communication that there have been maybe 2 or 3 instances in the last 5 years where we've come back to you, either written to you or I've come back to you and said that this is really a good time to deploy capital in equity markets in general and maybe top up with us. We believe this moment as we speak is something which is similar. And the reason why we are hosting this webinar is exactly in that context that we think that it is a great time for you to put capital at use. And if you have capital for, let's say, next 1 to 5 years, it is something where you should actually deploy that capital within Indian equities and with Prescient Capital in particular, because the odds of making disproportionate returns from here on are significant. So moving on to the presentation, a quick recap on our data about us and our track record. We are a public market PMS which has an AUM of close to 350 CR. We've been in existence for close to 5 years. We've consistently beaten these indices. The relevant index here is the Nifty Small Cap Index, which we've, I think, beaten by around 6 to 8% across the 1 to 5 year horizon that you see here. We do report BSE TRI, but the more relevant index for us is Nifty Small Cap. Moving to the presentation, and we start this presentation by defining the period of the last 18 months. Why we've chosen this last 18 months is because I think over the last 18 months, there has been a significant macro geopolitical headwinds which the world in general and India in particular has seen, due to which the equity markets in India have been in a kind of a panic mode, which has resulted in a significant correction and drawdown in the indices. We think that starting from, let's say, around October 24, when the Gaza conflict kind of started, there had been one instance after the other, which has significantly dented the sentiment of the global trade, and as a result, the outlook on the economic growth of major leading economies in the world. We started with the Gaza conflict in October 24. Then we had the first set of tariffs by the US. In around May 25, we saw Operation Sindoor, which kind of lasted for a month period. And then in August 25, there was second range of tariffs, which were kind of disproportionate on India. Those tariffs lasted for a while. And now we are in a period where around from Feb 26, we've seen the US-Iran war. In the background of all of this, we've also seen a pessimism around the physical economy and also the incumbent software IT businesses by the AI innovators, the incumbent 7, 8 AI companies. And that has also kind of dampened the sentiment on around employment, on around job creation. So in this background, I think it is important to understand that the Indian indices have also seen a significant correction. As you see on your chart, the small cap index has corrected by around 13% over the last 18 months. The micro cap index, which is also relevant to us, our kind of investing, has corrected by around 17 odd percent. In that background, our portfolio has stayed in black. It is important. It's not something which is on an absolute scale a significant return, but from a relative context, which is always relevant when you look at things from a relative to the market and the indices you're working with perspective, I think we've kind of given around 0 to 1% return, wherein the underlying indices have corrected by around 13 to 18%. So it is something which is uh, a kind of an outperformance compared to indices, and we will cover more of this on around the portfolio and why we think it is something which is a gold building block from here on to invest more. If we look at the indices, they just show one part of the picture, which is the return, which is the weighted average of the companies which are part of the index. If we look at specific stocks, the important point we want to make in this particular slide is that the the important point we want to make in this slide is that the individual stock level correction has been even more significant, or maybe you can just say it is brutal. It's because uh, the individual stocks have corrected. If you look at the large cap companies, they've corrected around 25 odd percent. If you look at the median, the mid cap companies have corrected around 33% on a median basis. The small cap companies have corrected around 38-39%, and the micro cap companies, which have seen the most brutal correction, they have corrected by around 50-55%. So, given this as the background as well, in addition to the indices, our return of around 0 to 1% is something which is a significant outperformance. Now, I think we've spoken about our outperformance. We've spoken about the statistical data around the returns that the market has given, and also around why the individual stock level corrections have been brutal. It is important to look at, zoom out, and also look at where we stand from a 5-year, 10-year perspective, and why we think that the current market levels are attractive for returns to be delivered, potential returns to be delivered over the next 1, 3, 5 years. In that context, we wanted to share some data with you. Again, the timeline that we're looking at here is 18 months. So if you look at September 24, the Indian markets were kind of expensive when you compare them to the indices in Korea, China, and Japan. As a result of which, we did see these indices kind of deliver outsized returns over an 18 months period. And if you look at India, which is the bottom of this chart, uh, these returns are in INR basically. So if you look at India, the returns have been negative. Now, I think it is important to understand that there is always a mean reversion in markets. These indices, given the point back 18 months back, they were at a cheap or relatively cheaper valuation compared to India. They had a good growth prospect, which is what's linked to, in certain cases, linked to spend on tech and AI, in certain cases, just the expansion of the economy. And as a result of which, they kind of delivered significant returns over the course of these 18 months. India, when we were looking at September 24, was definitely expensive. And given the macro headwinds which we spoke about in the beginning of this presentation, India kind of faced a tough situation over the period of 18 months. Now, given this is something which is behind us, something which has already happened, we think that India has seen a significant drawdown compared to all global markets. And given the fact that there is a mean reversion which happens in the market, India seems to be poised as a good prospect of delivering returns over the course of next 1, 3, and 5 years when we compare them to global markets. When we also look at the data about India, this hypothesis also gets validated by that. So in this slide, just want to pause here and give you an understanding of what we've covered in this. We've gone back in time to around 1992, and we've tried to find out such instances, like the one which is just panned out, that how many of such instances actually exist in the past, where over an 18-month period, markets have given subpar or negative returns, and how have the returns panned out over a period of 1 year, 3 year, and 5 year from there on. So if you look at this slide, we kind of identified 10 such time periods since 1992. If you look at the top of your slide, for example, April 1992 to October 1993, it's one such 18-month period where the market gave a return of minus 35%. And for a period of 1 year after that, October from 1993, market delivered a return of 58.5% over 1 year, 15% over 3 years, and 11% over 5 years. Now we found 10 such instances, and the important thing which comes out as an outcome of this particular analysis is that in the 10 out of 10 instances, the 1 year return, the 3 year return, and the 5 year return has been positive, has been significant. If we look at this particular data. Now, the median returns, which is shown at the bottom of your slide, shows that over a 1 year period, almost all these periods had positive returns. The median return was 42.5%. The 3 year return was 60%, and the 5 year return was 98%. Now, you may argue that did this 18-month period last exactly over 18 months, or was there some more correction which happened post these particular time spans? The answer is yes. The future is something which is not perfect. Nobody knows. But if you do zoom out more than a period of, let's say, 3 months, 4 months, 5 months, 6 months, and you look at little longer term data, which is 1 year, 3 year, and 5 year, the odds of you making a significant outsized returns are significantly tilted in your particular favor. So we wanted to highlight that with this particular data. We also try to capture major geopolitical events like battles, financial crisis, and pandemic. And in almost in all the instances, we saw that the 1 year recovery of the particular index has been significant because most of these events, if I may generalize it this way, they do create a short-term kink in the supply or the demand. But most of these events typically either the supply change or the demand kind of absorbs the impact of these, and the world basically starts moving on. Or these events don't last for more than a year or say 6 to 12 months. Therefore, markets find their own way to grow and look at the broader data, which is linked to growth. Now, coming to the valuations in India, and I think I briefly touched upon the fact that back in September 24, the valuations for India were specifically expensive. Now, this chart does cover Nifty 500, Nifty small cap, and Nifty micro cap 250, and this considers their trailing 12 months PE data. So clearly comes out that back in June, September 2024, India was expensive. India was trailing at much higher levels than its 10-year median PE multiple. And as a result of which, the money went out, the FII money went out, and India also saw both a time and amount correction over the next 18 months. As we see the data right now, sitting in March, we think these indices have significantly corrected from their levels around June 24 and September 24. In fact, these levels, as we see right now, are even lower than the 10-year median levels that these indices have traded at. What that essentially means is, we typically say in investing that if the indices are below their 10-year median multiple levels, then it is definitely a very good time for people to start allocating more capital to equities. Which form and shape they take, that is subjective, but these are the levels. If your indices are lower than their 10-year median multiples, these are the levels at which you should start deploying capital to equities. What we also covered in the chart below is the fact that how our strategy behaves vis-a-vis these market levels. So cash is kind of a contra to how we see the particular market. If our cash levels are up, this means that we see that markets are expensive and there are fewer opportunities for us to deploy capital. If the cash levels are low, we think that the markets have started correcting or they are in a reasonable multiple at which we can start investing capital. And hence, the amount of cash goes down in the fund. If you would see, our cash levels have been up at times where markets have been at rich multiples, and our cash levels have been down when either the indices are the markets have corrected or they've been trading at reasonably low to cheap multiple levels. As we see right now, our multiples, the market multiples are cheap, and as a result of which our cash levels are also significantly lower. So again, emphasizing that this is a good time for you to deploy capital in equity markets. I'll now pass on.
I'm Anubhav. I'm Sunal's co-founder. Very sorry that there was a slight technical glitch because of which I couldn't unmute myself, but that's resolved now. Sunal, can you present the deck? It's not showing up on the screen. Or do you want me to present the deck myself? Yeah. So coming back to the presentation, first of all, thanks for joining in on a weekend morning. I'm quite sure that you guys would have much better things to do, but thanks for spending the time with us. So till now, Sonal has mainly covered that market levels are now very conducive for new capital, and any investment that we do from this point on should deliver, in all probability, very healthy returns, especially if you are investing from a slightly longer term perspective. Uh, because valuations have come down, there has been a long phase of correction. So in addition to that, what is also true is that India's domestic macros continue to be very healthy, very strong, despite the global geopolitical situation. The global geopolitical situation has been very bad for the last 18 months. There has been one war after the other. But India's domestic macros continue to be very healthy. In fact, we believe that they have been some of the macros are the best ever that we have seen in our 15-year-long investing careers, and I'll cover some of them. Sonal, can you please go on to the next slide? So firstly, the two most important indicators, India's GDP growth continues to be pretty strong. If you look at even the last 2 quarters data, the GDP growth numbers were very positive and even, in fact, better than some of the preceding quarters before that. Uh, so till now, the geopolitical situation hasn't dented the GDP growth, first of all. Secondly, India's inflation is at an all-time low. The kind of inflation numbers that are coming in that are best in the last decade. In fact, if you look at it, India's inflation is now at this point of time lower than US inflation, which is something which we haven't seen because US inflation is above 2.5% and India's inflation numbers are coming lower than that. So that provides RBI lot of headroom to cut rates, which it has, which we'll cover in the next slide. And also because of this oil price shock, obviously oil price is a big negative for India because India is a net importer of energy, and this will obviously bring in some inflation. But because the currently the inflation numbers are so low that there is some like headroom to absorb that. Even this recent most shock that has happened because of the outbreak of the Iran-US war. So the inflation numbers and GDP growth continues to be very healthy, and in fact, in among the large economies, India is clearly the fastest growing one. Sonal, please move on to the next slide. Yeah, and if you look at like the NPA numbers, the credit quality of the banks, as well as the corporate leverage numbers, they are the best ever in the decade. So over the last 10 years, RBI has done a remarkable job of cleaning up the Indian banking system. Both PSU banks and private banks, they are in their best ever health. Like in fact, the PSU banks are especially in their like best ever balance sheet that they have ever had. Like the banking NPA numbers are at their all-time low in the last decade. Corporate leverage is at an all-time low. Corporates have a lot of legroom now to like take some leverage and fund their capex. And both PSU and private banks have are like will be able to lend and fund capex. So from that aspect, like both the banking and the corporate balance sheets are in their best ever position in the last decade or more. Yeah. Uh, Next slide, please. And specifically, like in the last 18 months, there have been three major domestic policy actions or reforms, if you call that, which the market seems to be completely ignoring. Because the market, and especially the FIIs, because what has happened in the last 18 months has been the selling by the FIIs of Indian equities have been relentless. So, because they focus a lot on the geopolitical situation and things like India is not an AI story or whatever. And there have been three key policy reforms, which is the GST rate cut, income tax rate cut, and RBI rate cut. These three major reforms and growth drivers have been completely ignored by FIIs, and we believe that this will drive earnings growth, and we are seeing signs of that. We'll discuss some of those signs. Will drive major earnings growth in the next few quarters, because the impact of these three drivers are yet to like be fully realized. And the market is slightly at, especially at this given point, it's too focused on the war and crude price and all, and completely ignoring these three major policy actions. Yeah. Um, First of all, we are all aware that the government of India cut the GST rate. Most of the items have now come under 18% GST slab, earlier from the 28% or higher GST slab. And this has started driving consumption, because things have become much more affordable. Because, and especially we wanted to highlight auto, because in auto, if you see that India is a price sensitive country, if the price of a two-wheeler comes down by 10%, it is like a major boost. And it's not only the GST rate cut, even RBI has cut rates also. We'll discuss like the amount of rate cuts we'll discuss in the next slide. But because the RBI has cut rates, EMIs have become cheaper, the installments have become lower, then your product price has become more affordable. The bike that you would have bought for 1,10,000 is now available at 1 lakh rupees, simply because the GST rate has been cut from 28 to 18%. That's a straight away 10% cut. And in fact, we talk about the headline 28 GST, 28% to 18% rate cut. But what the government has also done is lot of the cesses, like even apart from the GST rate, there used to be a lot of cesses, like on especially on SUVs, actually 28% plus 3% of cess. So that all of those cess has have also been done away with. So if you are going to buy an SUV today, it's actually 12-13% cheaper. So the prices have come down. Your the interest rates have come down, so your EMIs have also become cheaper. Uh, and also like your income tax that you pay has also come down. So it's a major driver of consumption in India, and it's actually started to reflect in auto numbers. If you look at this slide, starting from October when the GST rate cut came into picture, the kind of growth that has happened, it's a major boost has come in across all auto categories, whether it's commercial vehicles, two-wheelers, cars, like the kind of, and these are annual growth numbers for each month. And if you look at the numbers, they are very, very healthy. Clearly, the impact of GST and other two policy actions are showing up. Next slide, please. Uh, like the one of the policy action is also the rate cut by RBI. Because of the low inflation in India, RBI has cut rate by 1.25% in the last 18 months. And uh, today, like if you go to buy a house or even take an auto loan or education loan, we believe it is one of the cheapest that it has ever been. The kind of interest rates that people are enjoying. Uh, so again, that drives consumption, and it's what is also happening is that this rate cut is also reflecting in the credit growth of the economy. So if you look at the chart on the right hand side, from June onwards, the credit growth sequentially has started picking up. It took some time because for the rate cuts to actually percolate into credit growth, it takes some time. There is lag of 1 quarter, but the credit growth is now picking up. People are taking loans and like buying things because uh, the uh, the rates are one of the lowest ever that has been in India. Yeah, next slide, please. Finally, the third policy action is that the income tax rates have also been quite cut quite significantly. Like I think below 12 lakh rupees, people don't have to even pay a single rupee of tax, and that is a significant change. It puts more money in the pocket of the consumer, and consumption was actually not doing that great. If you look at last financial year and the quarters before June. And it's a mix. It's not only the income tax rate cut, it's a mixture of like RBI rate cut, it's a mixture of GST cut. Consumption has started picking up. Like if you look, this chart shows the private consumption expenditure, and it's started picking up for the last 2-3 quarters. And India is a consumption driven economy. Consumption accounts for actually 60% of India's GDP, more than that, I think. And this pickup also reflects in the GDP growth numbers, and it's good for like all consumer facing sectors, and whether it's discretionary, whether it's staple, whether it's autos. The pickup in consumption helps drive earnings growth for these sectors. So all in all, the three policy actions that we have that the government has taken, we believe they are significant reforms, and the market is not appreciating these three reforms. And sequentially, these will even drive earnings growth stronger because it takes some time for the policy actions to like fully percolate into the real economy. So all the market is focused on at this point of time is the Iran war, the shock because of the oil price hike, which we at least believe is slightly a temporary phenomena. It should get resolved, hopefully. But these three reforms have been done and they are forever. They are perpetual, and the market is completely ignoring them, especially the FIIs. So, yeah, please on the next slide. Uh, so now I'll come to our portfolio performance. Uh, our portfolio continues to perform well on all the important dimensions, whether it is earnings growth, whether it's ROE, whether it is health of the balance sheet. Obviously, stock picking is our job as your fund manager, and within obviously we have discussed that valuations have come down. Government has taken several policy actions in the last 18 months. But even within those larger picture, like we believe the portfolio and the stocks we have chosen, of course, with some bias, but we believe they are very exceptional businesses. And even if there is some shock, oil price shock or some inflation shock for 1 or 2 quarters, they will be able to handle those shocks very well. So this slide summarizes how our portfolio has performed over both longer periods of time and this financial year. So if you look at the sales growth and EPS growth number, both from longer horizons, last 5 year, last 3 year, and if you even look at the 9 month FY26 sales and EPS numbers are the median and average growth numbers for our portfolio companies continue to be very healthy. They continue to grow strongly. If you look at the bottom left pie charts, so our portfolio companies continue to be very strong in terms of their balance sheet. 72% of our portfolio ex lending companies, because lending companies, their business model is to like lend, and they will have leverage on their balance sheet. But ex BFSI and lending companies, 72% of our portfolio companies are actually net cash companies. They have like cash on their balance sheet. So this gives them the firepower and the wherewithal to, like, if even if 1 or 2 quarters are there is some shock because of oil price, they will be able to withstand them very strongly. And in fact, if you look at this green colored pie chart, none of our companies have a debt to equity ratio of more than one, not a single one. So we are very positive about the balance sheet strength of our portfolio companies. And the final slide on the bottom right is the ROE of the companies. So again, like if you look at FY25, or if you even look at longer time periods like last 3 year or 5 year, uh, we believe that our portfolio companies have top quartile ROEs. And this 17% kind of ROE that you look at, this is including BFSI. This is for our entire portfolio. Why am I mentioning that? Is that banks and lending companies are slightly regulated businesses. So they can't have, like, because RBI has regulations in place that you can't have yields more than that and things like that. So for a regulated industry, the ROEs are capped at certain level. So if we take out actually the BFSI companies, the ROE of our portfolio companies will be even higher. So just to summarize this slide, top quartile earnings growth, balance sheet health, ROE for our portfolio company. Yeah. So, and again, this looks at the earnings performance of our portfolio companies for the last 18 months, because that is the period of correction or drawdown in the market. So again, our portfolio overall continues to deliver much higher earnings growth compared to the relevant benchmark indices, whether it is Nifty 500, which is the benchmark that SEBI says we should benchmark ourselves against. And though we believe that Nifty small cap 250 is more relevant because we are a more small and mid cap strategy. But we have highlighted our earnings growth against both the benchmark indices, and you can see that we continue to deliver much higher earnings growth compared to both the benchmarks. Yeah. So this is sort of the final slide. Here we want to highlight is that if you look at our portfolio is typically somewhere between 25 and 30 companies. But if you look at the performance of our top 5 and 6 companies for the last 18 months, which has been again the period of correction for the market, where, like Sonal was mentioning, benchmark indices have not done well. Individual companies have corrected more than 30-40%. But if you look at the performance of our top 6 companies, and the stock price performance is the darker, like blue color on the left hand side, the dark blue column. So apart from whole time transformers, all our positions in the top 6 have either actually delivered positive returns or like been flat. Voltamp is like the only one which, and we believe unfairly so, but whatever, is the only one that has corrected. And the lighter column that you see on the right is the earnings performance, the 12-month earning performance during this 18-month period. So all our companies have delivered very healthy earnings growth during this phase. So, why we wanted to highlight this is that inherently in our strategy, what we try to always do is that we always focus on increasing allocations to our winners and reducing allocation of those companies which are not performing that well, even within the portfolio. So these top six companies actually account for 40 to 45% of the overall portfolio. And because they have performed quite decently, they have actually absorbed the pain in the rest of our portfolio. To be very honest, like no matter how much work we do, how much thesis we uh, build through our like research, there will be always companies in our portfolio which will perform very well and deliver or outperform our expectation, and there will be always some positions that will not perform. What we always try to do, and I'm again repeating that, is that we always try to allocate more to our winners, because then they are able to handle the pain during such kind of corrections, and that has happened. If you look at the again the top six companies, they have done actually much better than the overall portfolio for us, and they have absorbed the pain. And if you look at the bubbles that you see, even at this point of time, apart from TD Power, which we believe is a very unique asset that we own, and we believe that 60x is justified for TD. Uh, 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 but leaving that aside, all the rest of the five positions, if you look at, even today they are trading at just like 16 to 25 times trailing earnings, which we believe is quite reasonable even today for the kind of businesses they are for in terms of earnings growth, ROE, every metric that you look at. So our portfolio continues to be cheap even at this point of time. Yeah, and I'll not talk about in detail about these top positions, but if anyone has any questions about any of our individual positions, we'll be happy to take that up in the Q&A. Yeah. So I'll end the presentation here. And just to summarize, our position is that the markets have gone through a difficult phase. We don't want to sugarcoat that. It has been a phase of difficult, like challenge. Even our portfolio has delivered meager returns if you look at last 18 months. But what we have been able to do is that we have been able to at least deliver alpha during this challenging phase. We have remained flat during this phase of correction when the overall and the broader markets have corrected much more significantly. And so we feel that whenever there is uncertainty in the market, we don't even want to deny that. And because of that uncertainty, valuations have come down, the markets have corrected so much. But whenever the market and it will happen. Maybe it will happen 3 months down the line, 6 months down the line. It will happen. Whenever the market will turn around, we believe our portfolio has withstood the difficult times well, and it's poised to deliver very strong alpha whenever the market turns around. So I'll stop it here, and we'll be happy to take any questions you have. Please feel free, don't hesitate, ask us anything you want to, because we also receive a lot of pings and requests from the client for a one-on-one interaction. Given these tough times, we understand the times are tough, but it's not possible for us to have one-on-one conversation with every client. So that's why we hosted this webinar. So this is your opportunity. Please feel free to ask any question you have. Uh, okay, okay. And guys, everyone on the call, please raise your hand, and we will take your questions one by one. Sonal, you are unmute now.
Yes, I'm unmute now. Yes.
So please raise your hand, and then we'll be able to yeah.
So Anish is the first one, Anubhav.
Yeah.
If you can unmute him.
Yeah.
I have. Anish, can you
Okay. Yeah,
repeat
yeah.
that?
Thanks, Sonal, Anubhav, for doing this and taking out the time on Saturday. Quick question, just on the macros. Wanted to get your thoughts on. I agree with whatever you've said, and it's the positive side. But if I flip the story in terms of what is the real inflation outside of CPI, and the fact that there is questions fundamentally on the nominal GDP growth and the way it is calculated itself, and the rupee dollar depreciation due to the FIF flee and therefore the vicious cycle. And if you look at where we are in terms of core earnings growth for some of the larger companies and some of the more fundamental staple sectors, which are indicators of the economy's health, it seems that there is an alternative picture that is being painted, right? Which is of a slowing economy, lower job growth, higher inflation in our real lives than what is shown in the CPI basket, and a large gap in tax collection. So, how do you reconcile all of this? Add to that the fact that the dollar is depreciating and the FIIs might not come back. So, what do you believe will drive the growth in market returns going forward over the next 18 or 36 months?
So, Anish, honestly, we can all like some of the macros, we can always debate. Like inflation, I agree that people say there is inflation in rent and some of the other matrices. But at the core of it, we have to believe some of the data that we see. And even if you look at the profitability of the companies, there is no like specific data because if there was inflation, a lot of our companies would also face that. And we track a lot of companies, and it's not reflecting the profitability or margin. Structurally, there is no decline. So I won't go into that debate on whose inflation number is right and whether it reflects the true economy or not. But at least from the company's profitability and earnings, there is no single data point to show that there is structural high inflation which is denting the margins of the companies, because that would reflect in the profitability of, because a lot of manufacturing companies that we track, there is no sign of that. And we get that some of the exchange rate and those metrics are difficult, and the exchange rate is honestly driven by the FII selling, because India has always been usually current account surplus, and that has cushioned our exchange rate. But the FII selling has been relentless. But again, uh, that is also a benefit for like from some of the export oriented. If you look at IT services companies, the exchange rate helps them, they become more competitive and IT services is the largest export out of India. So if you look at any one macro, there will always be sectors that are benefiting from it. There will always be sectors that are getting hurt by that. So I like I said, we are seeing uh, grounds up in the kind of earnings growth that we are seeing, and the kind of acceleration, the kind of capex plan that companies are announcing. We don't see any sort of very overwhelming like structural challenge to the corporate India. Yeah. They can, in fact, like we were saying that in some of the sectors, we are seeing benefits of reforms like GST cut and things like that. Yeah. Anish, do you have a follow-up question?
No, I think he's good. Yeah.
Uh,
Next is Anumeha.
okay.
Hey Anubhav, Sonal, thanks a lot for that. Sorry, I'm Anumeya is with
So
me. I'm
both of us are like joined together.
Hi,
Hi.
hi, hi, hi. Hi, guys.
Hi. I actually put the question there, but I understand the 18-month drawdown. But the thing is that, I mean, we're at about 10% drawdown right now. The drawdown could further extend. And as you have seen, shown before in previous wars, the drawdown have been up to 30, 35% as well. So what do you think about that? I mean, it's impossible. I know it's impossible to time the market, but should we start deploying slowly? Should we deploy in bulk? What do you suggest there?
So again, I think a question to which there are many answers. Therefore, we've taken a 1 year out window
Mm,
because in 3 months, you are right. Maybe the drawdown can increase from 10% to even more. If you look at the 18-month drawdown, I think the numbers are even more significant. If you look at the indices, so difficult to guess. Like if is there a -5 or a -10 or a -15 over the next 3, 5, 6 years, 3, 5 months? But to answer you on the how to deploy, see, it is about two parts to it. One is SIP always works. I think we've
mhm,
seen in our own data set and we've read a lot about fund managers that anybody who's been doing an SIP, forget the timing part
mhm,
of it, basically has gone and seen around 3 to 5% more returns than somebody who's trying to time the market. And if you look at our memos that we've written in the last 5 years, we've repeatedly emphasized that timing needs to be thrown out of the equation. And SIP is the best product. So somebody who is just incrementally deploying, that is something which is far better in return. When I say far, 3%, I think is significant outperformance for an SIP guy compared to somebody who's timing the market on a good or a bad day, basically. That's one. Second, I think we are the buffer players in the middle where we are doing that spread out event even for you. So, for example, if you've given us X money so far, and even if you give, let's say, another X hypothetically to us, basically, we are not going to go ahead and deploy that capital tomorrow or over the next 1 week,
mm,
assuming this is something which is a once in last 10 years kind of an event and we need to make outside returns. We look at two things. First is performance of companies, given that there is a background of a supply shock or a energy shock. And hence we will try and look at companies from their earnings perspective in Q4, Q2, Q1, Q2, and spread out your capital in that perspective. And secondly, we are in the buying zone here, basically, right? Now, the buying zone needs to be in a disciplined manner. So our discipline basically comes from how we spread out your capital over this particular period and how we deploy your capital, assuming, let's say, there is another 5 year, 5%, 10% drawdown from around. If you look at last such instance, where between September 24 and December 24, the market started correcting. We started buying a little bit, and I think we started deploying capital.
mhm.
People who joined us between this particular period, we deployed some 30 odd percent of the capital, even though the markets were going down at that time. In January, also, we deployed a little, but in February, the significant 50% kind of deployment happened for us, basically for clients who had money between this particular period. So, just
Okay.
taking this as an additional example where see, we love to be in cash because cash is tactical for us. We think these are good deployable levels. Are these the absolute rock bottom deployable levels? No.
Mm,
Statistically speaking, the charts also say that, and hence we phase it out over 3, 6 months for deploying capital. So part one, you can do SIP and you can do it on your own, or we are doing it any which ways on your behalf.
got it. Got it. That answers my question.
Sure.
Thanks.
Next is Anand. Anubhav.
Hello, hi. Hi, Anubhav. Hi,
Hi,
Sonal.
Anand. Hi, Anand.
Thanks for taking the time out. So I think you had one very interesting chart where you were showing how the markets, the Indian markets, and have performed since September 24, I think it was, versus the global peers. So that obviously shows that the Indian markets have
Sonal, can you,
underperformed.
sorry, Anand, interrupting you, but maybe you can pull up the chart, Sonal, if
I'll
it's
just do.
that will help the conversation, I think.
Yeah, that's helpful. So in the chart there, I think you were showing that the Indian markets, if you just go back up,
Yeah.
if you were looking at the relative bar charts. Yes.
Europe.
Yes. So this does show like, and I think Sonal, you were making the point that the markets are cyclical. which may or may
Hmm.
not mean, but let's say it does mean that because the Indian markets have not done so well over the last 18 months, they may do better. But if I,
Hmm.
that is one aspect. But if I now look at the further earnings potential and how the markets are today valued in India versus the other bars that you see, how do you guys
Hmm.
think about that? Like, not just not in terms of what has happened over the last 18 months, but if we were to think of this like a fresh slate, like what is the
Hmm.
future earning potential of India versus the rest of the markets? How are we positioned there? Would you guys have any views around that? Thank you.
Anand, to be very honest, and I'll I'll be honest in that we don't very actively track all the international markets because we invest in Indian equities. So first of all, obviously, we wanted to present this chart uh, because just to make a sense of what has happened in the past 18 months, because there is in hindsight, there is a lot of conversation around that this FIIs are pulling out because India is not an AI market, which seems to be because if you look at Bovespa, which is Brazil, it is also not an AI market. I don't think there is any AI company in Brazil. So in hindsight, we are trying to just and even uh, uh, that thesis that starting September 24, Indian markets they were frothy on an absolute level. They were expensive on an absolute level, but some of the other markets were also expensive. Like Nasdaq was expensive even back, and Nasdaq has still continued to give good returns. We understand that there is an AI play there, but at least that starting valuation argument also is not very like accurate. And in hindsight, we may try to like make a sense out of it and give different type of reasonings that India is not an AI market, starting valuations were expensive and all of that. But all we are trying to say is that there is no single reason and there is no very solid justification of why only India has underperformed in such a because if you look at the global equities, last 18 months has been actually a raging bull run. If you look at even this chart, the kind of returns that all other markets apart from India in the top 20 markets across the world have given. So that is what we wanted to emphasize that for whatever reason India has underperformed and what we have seen is that historically mean reversion is like one of the biggest truth in equity investing. Typically things mean revert. And then we try to make sense of it that this was the reason or whatever. But mean reversion, at least we have seen, it always plays out. In fact, that is the bedrock of investing. When we invest in something which is undervalued, we believe that it will mean revert and get like its value will get discovered. So that is the limited point we were trying to make. But very honestly, we don't have very deep understanding of how the other markets are poised in terms of earnings versus valuation. But one thing I'll say is that if you look at some of the best performing market, whether it's Kospi or Korean market or Japanese market, there is a like uh, raging bull run happening because of the AI capex. And if you look at something like Kospi, I think we have discussed on a one-on-one basis also that two companies, Samsung and SK Hynix, are I suppose 40-50% of that
30%, yeah.
index. Yeah. And it's being driven by that memory chip shortage and all of that. So some of the strong earnings that we are seeing in markets like Korea or Japan or even Nasdaq for that example, there is reason to believe that it is slightly getting overheated. The kind of AI capex and things like that, can it keep on continuing without? Because like if you look at it, uh, like AI is not like even some of these large AI companies, they are not justifying their valuation in terms of the revenue that they are delivering. So there can even be a case that the kind of earnings growth that this bubble is generating, it is actually a bubble and it will like burst at some point of time. But leaving aside the AI economies, I think like and we were emphasizing that we are seeing good growth in India and sequentially like I was also pointing at is that because of the reforms policy actions we are seeing actually sequential uh, earnings growth improving only. And our thesis is it will only improve in the next 2-3 quarters. Barring this like crude shock, because this is something very nobody knew that the US would attack Iran in like last 1 month or so. Barring this very uh, and we hope that it is temporary. This crude price shock, I think uh, Indian earnings will deliver. And again, from an absolute basis, given the earnings potential and given where valuations today are at in India, that we are finding even from a bottom-up perspective, I think the risk reward in terms of earnings versus valuation is quite attractive in India. Anyone else?
Anyone in the chat box who's left?
We'll be happy to answer even like if you have some specific questions about the portfolio or yeah, any positions that we'll be very happy to answer those also.
Quick question. Assuming there is, we start to deploy and there is capital flow, are you guys looking to sort of, given where the market is it more a doubling down into existing ones at better valuations, or are you able to find new ideas that are sort of attractive that previously might not have been due to valuations or due to structural quality of the companies?
So, quick answer, Anish, both basically. So, 18 months back, a lot of good, interesting, growing businesses were expensive. Uh, and they have significantly corrected as we were talking about the individual stock price correction. Our process is that at any point in time, if you're looking at deploying capital, you compare the companies in the portfolio to the potential companies list that we want to invest in, and the if a new company basically merits uh, inclusion in the portfolio, we will put money in that one. If a company in the portfolio basically is growing and has corrected significantly, it will also get allocation. But let's say there's a company which has weak growth prospects over the next 1 year, 18 months, the chances are we will tone down its allocation and redeploy that capital in the two buckets that we just spoke about, like the ones which are doing well in the portfolio and the ones which are potential but and have a good potential to grow. So at any point in time, we are always looking to do both. We are not in a high churn kind of a strategy here. So the chances are that we will redeploy maybe 30-40% of the capital in the existing names. Some existing names which in the portfolio Anumat mentioned are still cheap and they continue to deliver growth. So the ones which we showed in the slide deck, we are deploying capital there. And there are some new names that we are adding. So at any given point in time, let's say over a year, 7-8 new names get added to the portfolio, and the allocation to them is natural, basically.
Does anyone have any more questions? Great. Then we'll end the session here. It was great talking to you all. And do feel free to write to us if you have any further queries or questions. Yeah.
Thanks, everyone. Thanks for your time. Look forward to talking more. Thank you.